Hello, everyone, and welcome you to the Soltesz Institute webinar, where we discuss how to set up an overall banking and payment strategy, especially for the high-risk industries. And I'm very happy because today I've got Adam Chong with us, who will open up his experience regarding the payment strategy, regarding the high-risk industries, and he will tell us a bit more about his project as well. So welcome you, Adam, and please introduce yourself to us a bit just to get to know you a bit better.
Good morning, Victoria. Thank you so much for having me. I'm excited to be here, and thanks everyone for tuning in. I am here in Orlando, Florida, in the United States, and I have my fifth startup, my third in payments. I've been in payments for about 6 years and have worked on the ISO side, selling in the SMB space, and then on the ISV side, doing the payback as a service model and selling to platforms. And I am now working at a company called Precision, and our goal is to help the vertical SaaS space own their data and be able to really bridge the gap between payments and other fintech strategies. So banking as a service, insurtech, lending. So really excited to be here talking about high risk, because it's certainly something that spans the fintech world and does not limit itself to just the payments ecosystem. Yeah, great topic. And thanks again, Victoria.
Of course, and thank you very much for sharing all your experience and wisdom. I mean, having a couple of startup companies behind you, that means that you figured out already what are the working ideas, and you can really understand how quickly this whole fintech space is evolving. So I think we're going to have a really, really interesting conversation. My name is Viktoria Soltesz. I'm the founder of the Soltesz Institute, and also I have a company, PSP Angels, which is helping online businesses to set up an overall banking and payment strategy, and this is my relation to the subject. So today we have a new kind of setup, because we have received so many good questions from the audience, and I thought that maybe it would be a good idea to go through all of those questions one by one, bounce some ideas, discuss all of those complexities and your ideas about those questions. So let's crack it in and see what is the first question. So Adam, I'm really curious about your opinion on here. What do you think? What are the key factors that high-risk industries should consider when choosing a banking or payment provider, and how these differ from traditional businesses? So what I think, what the question means is that a lot of things that I'm getting from my clients as a question: Victoria, who is the best bank? Who is the best payment service provider? Where can I find the best merchant account? And obviously, in the industry as much as I am, there is no the best. But what could be those key factors, and mainly for these high-risk industries, that could give a complete nightmare or easy way to processing? What are the main aspects on that? What do you think?
Yeah, I think where the payments industry is going is multiple providers. Being able to hedge your risk by having several different PSPs to send transactional volume through is only going to help with your risk appetite on the PSP side. So when we worked at Stacks, we originally had 2 PSPs that we worked with as kind of our sponsor banks, our acquirers. And as we continue to go through M&A and scale, we found more and more need to bring on more providers, especially as we got into the platform ISV model. And the value there is we brought on some providers that wanted to particularly focus on some of the high risk. They obviously want to charge more, but they wanted to be able to provide more book of business, but they didn't want solely our high risk. And so I think for high risk businesses, they need to understand that everybody's got a threshold. Some people are willing to take on more than others. Obviously, the bigger banks are able to bring on more risk, I think, overall, but they've got to balance it out with some businesses that are bringing on low risk transactions. And so I think having multiple providers is important and crucial. I think the other thing is, as you kind of plan for, your kind of strategy overall, you've got to consider that the relationships you have with multiple providers is really threaded through a really good chief risk officer or someone that's involved in the compliance piece. You've got to have a strong base and strong foundation before you get into some of the high risk businesses, because it's tough. So probably couldn't overpay somebody to oversee your on the risk side. And then I think the last thing that you want to focus on overall is the underwriting process. You know, anybody that's in high risk knows they're going to go through an intense amount of scrutiny. And so if you're asking them for, you know, everything and then some, as we joke in the industry, like, you know, your firstborn child, they're used to it. And so don't be afraid to ask for absolutely everything you need to, because you're getting in business with these people that can really take your business, you know, and flourish, or can sink your business. And you want to make sure that you're getting in business with the right sorts of individuals and businesses.
I agree with you on that. And since we also started with high risk, I think high risk clients are different than your everyday merchant, simply because they know that they're going to have a problem. So they know exactly that bank and the payment provider and the merchant account is not going to be an easy ride. So they are already prepared for all of those weird conversations, to open the books, to go through everything. And they know that they have to be very particular, because they experience that high risk is for everyone who is involved. So it's not just you are as a business or the activity is risk, but also the providers that you are picking might pose a little bit of a higher risk on your operation. And I know that in the States it's completely different, because the banking systems are different, and, you know, the ISO culture is also different. But all over the world, you have seen often when there is someone who just got a mid, and they proclaiming themselves that, all right, now we are a high risk provider, but the merchant might not even understand what are the risks when they are getting involved in so-called, you know, shadier kind of providers. And if you don't know, so it is also a very, very important thing, as you mentioned, that do a full due diligence and really understand that why this provider is willing to accept high risk. Is it because they are killing it on the low risk portfolio and increase a bit of a risk appetite and get some money on the side, or they are just focusing on the high risk for the quick buck, and then they might onboard someone who is even higher risk than you, which can jeopardize the whole portfolio level. And then when the financial institution is getting an audit or some kind of problem, they freeze the account and your money is frozen with it. Or even they have a penalty, or they pull the plug and they go bankrupt. And then you are left with chasing your money in some kind of offshore provider who was very convenient at the beginning because they onboarded you in 2 hours. But then after that, you know, when you're losing the money, what are you going to do? So I completely agree with you on that. The due diligence is extremely important, and based on that is the diversification as well. And I think
I'll add, Viktoria, on the chargebacks piece, which we didn't really talk about too much. You know, typically you're going to get some sort of threshold within your contract agreements with the payment provider, with your acquiring bank, that says, you know, anything over 1.25%. It's important to know that that counts for transactional volume as much as transactional dollars, you know, whatever that threshold is. But that's going to be really important for those high risk businesses to negotiate on. Probably less important for someone that's more traditional, that, you know, obviously you never know what's going to happen, but typically you're not going to see much of a chargeback issue if you're processing payments in food and beverage. But certainly on the high risk business side, you might want to try negotiating that rate a little bit higher, depending on what you think you can control. And I would even put up some parameters internally to make sure that you have a threshold that's even below the threshold of your contract, to ensure you're keeping out the bad actors and, you know, able to support the rest of your business entirely. But if you were to get shut down with a provider, that's where I think there's value in having multiple providers. Yeah. So that way you can just take your business and move it to, you know, a different provider in case, or just so you can have, you know, maintaining your financials.
That's right. And it also depends on the target area, I feel, because if you're targeting, for example, Africa or Southeast Asia, obviously you're not going to use the same providers as you're using in the States. And being high risk, it even increases the complexity of that, because how are you going to provide a good customer service, a good customer experience, a seamless checkout, reducing the high risk, and integrate everything to your payment orchestration platform. And on top of that, making sure that you pick the right guys to work with, right? Because then you did all the due diligence. Because if you're targeting an area that maybe you as a business owner, you've never been, it's very hard, mainly when you're a high risk, when who do you know kind of relationships apply everywhere, mainly in finances, that you go out there and you trust the provider, and then you integrate, and then you actually optimize the user experience on top of that. So I think this is where a good platform is coming in, right? So that platform will be able to not just only give you options of the pre-integrated partners that the platform is working with, but also all the fraud detection ways and the cascading part of the differentiation of the providers and whatnot, right? So this is basically what you guys do as well, no?
Yeah, exactly right. The thesis and basis for what Precision was started for, and frankly, it wasn't specifically to target the high risk market, but we do see some value there for sure, because I think they're kind of pushing the envelope as a subset of businesses, that there's value in, you know, diversifying your risk, if you will, and as you think cross-border, to your point, there's value in, you know, if you're going to go into Africa, maybe you want to go in with 3 providers instead of 1. Gives you a much stronger stance to ensure that you can use 100% for those that are using your platform.
That's right. Yeah, so this question has so many aspects of it, but
sure.
yeah, let's go to the next one. What do you think? What are the most effective ways to diversify payment methods in high-risk industries without sacrificing the security compliance? So what do you think about this? The different payment methods, because it's no longer just the cards or just the open banking. There are multiple ways, mainly when you're going to jurisdiction, then you're seeing, you know, expressions that you have never even seen before, like, oh, this is what you're using as a payment there. So what do you think? What's the sacrifice here?
Yeah, I think it's so interesting because so much has come online in the last like 5 to 10 years, and in terms of methods, right? The buy now, pay later through PayPal was a really exciting product that's launched. Obviously, there's a ton of companies that are out there doing kind of this micro lending process, which on a risk side is a whole lot lower in some regards than taking a credit card. You know, you're up into smaller chunks, which makes it a little bit more affordable for folks. So I think that's a really interesting model. Crypto, which is certainly not my area of expertise, but has opened up a whole new world in terms of cross-border transactioning and taking payments. There's obviously hundreds, I believe, of different ways, different crypto coins that you can accept payments for. And it's a whole different process of underwriting and scrutiny, but it is a different process that could allow for a little bit more transactional volume through the high risk markets other than just the traditional credit card models. Because again, some brands are a little bit more hesitant than others to, you know, slap their logos on certain places, you know, certain high risk industries. I think it also matters that kind of your payment methods based on how you're collecting transactions. So if it's all e-commerce shopping carts, if there is some sort of human interaction with like a payment link or a hosted payments page or an invoice, but there's so many different ways to take payments. And I think about a high risk industry, the more conversational face-to-face you can have, I think the risk is going to come down naturally. As we know, in the payments world, most fraud is coming through written checks that are put in the mail, or a lot of like just e-commerce blind transactions, you know, no interaction with the individuals. And that's where a lot of fraud comes from. So what do you think, Victoria?
Yeah, actually, I know that high-risk clients can go very creative as well, right? As we have seen that we used and abused all the vouchers and the top-ups and the gift cards, and as the crypto came along, people saw it as an opportunity for getting to declare some ink for the tax office, or even, you know, just bypass certain rules and regulations of the card schemes and the banks. So obviously this comes with an inherent risk, because if there is an opportunity to scout the system, there's going to be some people who are taking advantage of it for sure. And mainly when you're a high risk and you're getting a bit desperate of not finding those payment providers you want to work with and paying extra fees, which you didn't really want to, then creativity can really fly high. And that's what I've seen, that different payment methods might not just come alive only to satisfy the needs of the users or the merchants, but also to ease the compliance procedures as well, if you know what I mean, just to bypass certain things. And then, of course, it comes with serious consequences when it comes to security, when it comes to compliance, when it comes to scalability, when it comes to, everything. And that's when you start to see also the subjective prices as well. So this is not something that you can count with, because today it's going to be costing you, 5%, tomorrow is 7%. Why? Because I said so. Take your business somewhere else and integrate and test them up for 2 months if you don't want to fork out the extra 2%. So there is no one size fits all, but definitely different payment methods can also jeopardize existing relationships. So for example, I had a client who was integrating crypto payments in the mix. And everything was good. That was not that much of a transaction in the crypto processing, maybe just a couple of % of the overall volume. But the traditional high-risk bank obviously freaked out, because now the company is also having source of funds which could be deemed as untraceable, coming from crypto, from maybe not really checked clients. And then it can enter the financial system through their banking. And that's why you always need to understand what is the risk of implementing a new payment method, how your existing payment providers are going to like it, because everything is somehow connected, because the money is going to flow through them at one point. And consider that. And there is a sacrifice, so there is still a good solution. It has to be really decided by you and the company's risk appetite if you want to go for it. But yeah, just to have different payment methods, is not really a good approach, because it can do more harm than
No, I completely agree. And I would even say, the vetting process is probably going to be a whole lot more long-tailed than a traditional business model. And going back to my call out for the chief risk officer, it's just so important that they truly understand all the compliance regulations. Maybe even reading some of the, do's and do nots and what's happened in the past, and, reading up at institutes like yours, Viktoria, to kind of understand what pitfalls to avoid. Because I think, we can all learn from each other. That's why we're here today. And there's a whole lot of value in understanding what kind of the schemes are out there to watch out for and determine if it's worth it. Because you don't want to just go and set up a payment method just to appease, new ways of taking payments. And if you do, you want to consider charging more, on the transaction, because you're in the high risk space, and because people just understand that that's sort of expected and accepted.
That's true. Let's see the next question. What other ones? So can you explain the importance of maintaining strong relationships with banks and payment providers, just what we discussed, and how businesses in high-risk industries can build trust despite their classification? Now it's a good one, because it's I know you scratch my back, I scratch yours kind of relationships, but you seeing it from a platform perspective, when everything is through technology, obviously it has to have some trust this way, right?
Yeah, exactly right. And I think, the word transparency is going to be key and crucial here. Again, you want to have multiple providers, but you need to let everybody know that there are multiple providers playing a part in the transactional risks. And you want to make sure that you're doing absolutely all you can to abide by the PCI rules, the banking industry, any regulations that are required out there. So I think that's going to, build trust from the get-go, the foundation, and continue to pursue like a PCI level 4, and just kind of be on the cutting edge there. But I think it's important to just continue to maintain trust through that transparency and clear communication. So if you see something interesting, see something strange, maybe even calls for a consistent, cadence of meetings with some of those banking and payment partners to ensure that it's not just communication from the high risk business to the bank and the payment providers, but vice versa. There are things changing, there are things evolving. Everybody's kind of kept in the know. Because truth is that just a little bit of a crack, as Victoria, as you kind of alluded to, one little small fiber of a crack is all you need to let fraud through. And you want to make sure that you're plugging that hole, whether it's on your side or on your side.
Yeah, I agree. And also, the thing is what a lot of people still don't really understand, that everything is changing all the time. Just because you had a really good relationship with a bank or a payment service provider 6 months ago, your business changed. You might actually enter new targets. You might offer slightly different kind of services. The regulation might have changed, mainly when you're in a high-risk industries. Maybe you need a license now where you didn't a year ago. And of course, the banks and the financial institutions are also changing. They are losing their correspondent accounts, so maybe their risk profile and risk appetite is changing. So it's always good to ongoing relationship and as you said, transparency, that really what's happening, and always tell them upfront what you are planning to do, mainly if it's related to anything like activity change, or you're changing your shareholders or your directors, board of directors, you're expanding to new market, you're changing even your fees. That could be, eyebrow raising for some of them. So that good relationship and that, for example, a good platform is important, because then you have traceable and transparent data to support what you're saying. I'm on the market for 5 years. I know what I'm doing, because look, these are all my records. Go through one by one. You can see exactly that. What is my real risk? It's not just because I'm telling you so, but because the data is really proving it. So that also could really help a business to be a strong case that even though I'm high risk, I'm not that much of a high risk. And then let's work together.
Well, and I think there's value in, hey, here's what we've done. We brought on this many accounts, and this is a percentage or ratio of accounts that we shut down. This is the number of applications we approved to number of applications we rejected based on X, Y, and Z criteria that, didn't pass the sniff test, that we didn't believe were legit good players, that, we found to be potentially fraudulent. I think those kinds of things, knowing that you're continuing to tweak your risk management, risk appetite, really helps to build a stronger foundation, across the board for your partners, knowing that it's not just chasing the bottom line at all costs, that you're doing your due diligence on every single account, being vigilant every special way. Honestly, this is even where we at Stack started to hire some people, whether they were junior, senior, or even C-suite level, from some of our financial institutions, because they knew the ins and outs of what was expected and what was needed to provide to, be more due diligent or do their due diligence. And so we started hiring people from some of the big institutions like WorldPay, Fiserv, and we got a lot of value out of their expertise, but also from the partnership side, it really helped to strengthen and fortify what we were doing in our operations.
Yeah, and it gives you substance as well, because obviously these guys made those decisions at one point, so they should know what they are talking about. So
exactly.
So that's definitely an extra point for sure. Yes. All right, let's see the other question. What are the common mistakes high-risk businesses make in their payment strategies? Oh boy, where do I start? And how can these be avoided through proper planning and risk assessment? I'm so curious about your summary, Adam.
You know what, I think, again, like I just mentioned, grow at all costs. I think one of the aspects of starting a business and taking payments is compliance. So just skipping over it, saying like, yeah, we'll get to it when we get to it, across the board, but specifically talking about, financial compliance and how you are or are not prioritizing that. It's expensive, it's costly, it's no fun. Oftentimes you need, dedicated resources just to maintaining compliance and getting compliant. And the question is, how is too soon to be compliant? The answer is it's never too soon. That could be something you start at very, very. And I, again, credit back to when we were Fat Merchant early days. We hired a director of risk and compliance, and that was his full-time job. And that's all he did, making sure employees were PCI compliant, making sure computer systems were set up appropriately, Obviously, when we went remote, that opened up a whole different can of worms for how challenging that was. But we never skimped on compliance. We always knew that that was an extremely valuable place to go and place to be and place to spend resources. And you really couldn't overspend on compliance, because it only takes one bad egg to really, mess it up for everyone. And so you want to make sure that your firewalls are strong there. I have other answers, but Viktoria, I'll let you kind of step in.
Yeah, it's just obviously we are working a lot with the companies as well. And I remember a case when a company came to me. They raised the funds, they developed the technology, they had the team, and everything was ready. And then I'm not even a lawyer, but then from a payment perspective, I found that why it cannot work, simply because you need to have either a license, or what you try to do is completely illegal. And this just shows that if you are not starting with the right people and the right advisor, it's so easy to spend a lot of money and energy and time on something which is not viable from the get-go. And even for big companies, sometimes I see that they are executing something without having a proper research around that from a payment and banking perspective. Because even though sometimes the legal team tells you that, yes, you can do it, but from payment and banking perspective, it classifies you as a very high risk client, or there could be an opportunity for wrongdoing, and that can really affect your whole payment flow. It can increase all your fees if you're in jeopardy by working with higher risk providers. So you don't even understand what could be the damage before you actually face the reality that, okay, that's the platform, that's the idea, let's connect banks and financial institutions. And when you get rejections all the time, that's when you realize, something is wrong. But it's still, you don't know what could go wrong, right? So that's one thing. And also the other biggest mistake of the payment strategies is that there is none. We're gonna put some payment providers. Maybe we get a cashier system or a gateway to get the report, so the accountants have to spend less time for reconciliating the things. But other than that, what to be afraid of, right? And if you don't know, you don't know what you don't know. So
right.
You really need to evaluate all those possibilities, that maybe if that payment provider is pulling a plug on you tomorrow, how is it going to really affect your business? And that's just because you are doing something wrong or they are doing something wrong. Simply, technological glitch. And then for, 24 hours, you can't accept payments. What's the cost, right?
Right. And we've seen that, sweeping across pretty much every payment business has had some sort of issue with something, related to fraud and shutdowns and funding times and funding timelines. And it's stressful, it's challenging, and it can really, really take a toll on the business as an operation. And I think, like I said in the previous question, it might not be fun to monitor things like number of, applications rejected, number of accounts shut down. But actually, one of Money 2020's Amplify recipients came, from Stacks Payments. And her job, I remember looking and listening to her and thinking, like, your job all day is to call accounts and shut them down. That sounds terrible, getting shouted at, getting yelled at, but it's so necessary. I think it's one of the most crucial functions of an early strategy for payments, is making sure that you're monitoring that and even celebrating that you're keeping out those that might be able to spoil the entire operation of what you're trying to do. So when you think about things like chargeback ratios, it's something to monitor, not quarterly, not annually, but like regularly, whether that's, daily, weekly, monthly, so that you can know where you're coming in at and why, and make regular adjustments to ensure that you're protected, really.
Yeah, and I think the two main group of companies who usually have a serious mishaps around the payment strategies are either the startups because they don't know what they are doing, or the big companies who are moving millions, but they are just too big and too bureaucratic to change anything. So you also need to be a bit flexible to, all right, this is newer, this is better, this can fit our user experience better. There's a new compliance, something came out. And then they are just too slow to react, and that time fraud can go through, and that can really jeopardize everything. Or technical glitches, as we said, that the whole platform is down and they cannot process payment and they didn't have a backup. So that's the case that big mega companies are having one bank account, huge companies processing millions with one checkout service, like, having Stripe, and that's it, and nothing else. And then the panic kicks in when there's no backup, and it doesn't cost a lot to have one, and it can cost a lot not to have it when you really need it. So
well, and I think you mentioned on the large side, I agree with you entirely. It's a good point. There's definitely a point where you want to hire somebody just to be your kind of data analyst, data scientist, business intelligence, to be looking at these things, no matter how large you get, maybe even going out and hiring a service to look at your book of business and see what you're doing, week over week, month over month, year over year, to know what to look for. And because it gets harder and harder, to your point, Victoria, as you scale, but becomes more and more important as you really get a bigger target on your back for fraud, right? No one's going out there and targeting necessarily the brand new businesses. They want to make sure there's some money in the bank to take advantage of. And so once you kind of get out there more and more, it's important to build this, stronger foundation and stronger walls to protect yourselves.
That's right. That's right. Question: why do so many high-risk businesses get rejected on the application or experience frozen accounts? And I think what the question is really aiming for, that even though that you are doing everything right, what can go wrong? So what is there that to show and you're not showing, or you're showing too much, or what is the level of information which is not too much for the providers? But also, can you experience frozen accounts even though that you as a business have not done anything wrong?
Yeah, there's obviously two parts to this question. The rejection on the application side, working in the SMB space and pulling in about 50 accounts a month personally, it was guaranteed there was going to be maybe 10, 15, 20% of my accounts every month that were going to be put on some sort of hold on the front end, the underwriting side or on the risk side, right? And it's so interesting because oftentimes, just again, the transparency piece is the most important. Just tell us what you're doing. I did have some people come in and say, look, I'm doing high risk. Victoria, I know you're big into like the gaming world. I had a few folks come in and say, I'm reselling tokens and these video games. That's what I'm doing. That's what I'm processing transactions for. I already have a PayPal account. I already have a Stripe account. This is my third account. Whatever it is. But honestly, the people that came in with transparency had a higher approval rate than those that came in and tried to kind of keep some things away. Because honestly, we as payment providers, financial institutions, this is our full-time job, is knowing how to keep you away. You can't be too clever, to keep yourself approved. And if you do, you'll get shut down right away. And so I think it's just really lay out a strong, clear understanding of what you're trying to accomplish, so that the trying to get you approved is incentivized to get you approved, but they want to see, what you're really working with. And so that transparency piece is important. And then on the risk side, honestly, probably the biggest reason why we would have risk holds is just processing a really, really transaction, and it happened to not report that on the underwriting side, on the risk side. And so even though I said my high ticket is going to be $15,000, I just got a $40,000 invoice. I'm going to process that transaction, and boom, your champagne lunch just turned into a frustrating point of calling and trying to figure out. No matter how many times I would say, like, hey, if you ever have a really great day or you're trending upward, just give us a call and let us know. Inevitably, probably half the time people wouldn't. And it's no different than you think about like traveling in the early 2000s, that you would call your financial institution and say, hey, I'm going to be taking my card international. I just need you to know, don't put a risk flag on it. You just let me know, let me process. And, that 2-minute conversation could save you from several hours of stress and frustration while out country on vacation. It's the same thing in payments. If you have something good come on and happen, doesn't matter how risk averse, like you could be an attorney, but still, regardless, if you process a really, really low transaction, you're going to want to let somebody know and just send some documentation through. And that really seemed to be one of the biggest challenges for us with risk holds, is just big ticket items. What about you, Victoria?
Yeah, that's the thing, that people don't really know what to share with the bank, because obviously if you are not from this industry, and of course you're out there managing your business and the payment is something which should support you, right? So why would you know all the compliance in and out? It's very hard to determine that what is enough to say and what has to be disclosed and what's important. And that can really take the attention away from the important parts. And as you mentioned, when we're still doing it in Europe, by the way, if we are going abroad and we are trying to use the card, we do need to call the bank and increase either the limit or tell them that, listen, I'm in a different country, let the transaction through. So this is still a valid problem. But the majority of the problem with this is that's also important to open an account, of course, and accepted by the payment provider, but to keeping it's a whole different kind of game. And mainly if you're high risk, you can still work with providers who are not that high risk friendly, by, of course, disclosing what you are doing, but channeling the transaction, which is high risk, to the high risk providers, and then use, for example, for your payroll, a high street bank. You can still do that, but you have a good, solid communication with the payment provider. Tell me what you want to know about. Tell me what are those red flags that I need to pay attention. Tell me what fits in your risk appetite and what's not, because then internally I'm going to slice and dice my traffic according to your need, and you're only going to get what I promised and I declared that I will send towards your way. Because mainly for high risk industries, they know that they can't just have one bank account and send everything through that. Different fees, different risk levels, different risk for them by using different providers. And that's how you diversify the risk as well as your costs and obviously maintain those accounts.
I think it's similar. Everybody can relate to some sort of traveling, going through an airport, and you have the agencies that are there to say like, hey, do you have anything sharp on you? Do you have any liquids? Right. Whatever it is. The more transparent you are, the easier it's going to be. But if you try to hide something and they find it, you're going to spend some time, behind closed doors being scrutinized. You might miss your flight, might miss a day of your vacation. It's not worth it. Transparency is everything, as is coming through customs and coming back into the country. And again, you need to declare what you have. And if you get found out that you might get fined, you might find jail time. I mean, it could be serious. And if you just tell them like, hey, I happen to bring back, some gem, like, oh, that's fine. If it's sealed, it's fine. Let's take a look at it. Okay, you're good to go. That's the same thing in the payments world. Like, hey, I'm going to be running this large transaction. Hey, thanks for letting us know, but you didn't need to let us know. But it's always worth being a little bit more cautious, a little bit more careful, especially on the high risk side. If you're running those large transactions, just to let your partners know.
That's right. And I've actually seen, believe it or not, when the competition is trying to run your business by sending some random transactions towards you. Wow. It's just so nasty, but actually it happened with a crypto exchange platform client of mine, that someone intentionally set up a different kind of platform and sending traffic towards that way that is going to be flagged by the payment provider. Then it's going to be shut down, and obviously they spend time, energy, effort just to reinstate the relationship or a new one. You can really a lot of money and time and effort and everything by just even paying attention to the little details. And it can happen because the bank is going to flag something that all your payments are coming from that state. How comes that all of a sudden China starts to send you transactions? It doesn't have to be a lot, couple of general transactions, and that's it. You're gonna freeze the bank account of the recipient for sure. So those are also important, that you really need to see that what could be done from the internal operation to filter out all of these external threats as well, and get ready for that, because as I said, people do get creative. And
I think I'll add one more thing, Viktoria, and it kind of segues into the next question. Sometimes it doesn't have anything to do with you. We had just, let's say in field service management, you might have a few back-to-back rejections on applications. And then the third person that comes in that's totally legitimate, has great, everything, gets an extra level of scrutiny just because we're a little bit more cautious on that, MCC code that we're seeing. And we're like, oh, we need to ask for all these other things. It might be a little bit more challenging. Same thing on freezing accounts. If we see there kind of a trend, to your point about China, like if you see a trend of transactional volume that's happening from one certain subsector or something, we might just put a hold on all of it. It might be nothing to do with you. You might be totally legitimate. So don't always assume that you've done something wrong in some way, but it could be that that's the market. That's the way things are going for that particular financial institution or payment provider. And that's really all it is just an extra level of caution based on certain factors that are, unbeknownst to you.
Exactly. And how many times we have seen that, oh, the visa processing doesn't work for another week. Wow, what have you done? Clearly nothing to do with you, but there is some internal conflict within the payment providers that something is going, of course it's not public, but you need to get ready for that, okay, maybe we are losing visa at one point. What's my backup? Not because I've done something wrong, it's just the circumstances. But yeah, exactly. Why do so many high-risk businesses get rejected on their application or experience frozen accounts? Yeah, this is what we discussed. And what's the number one mistake they make when they choosing banking and payment partners? Yeah, the biggest mistake, as we said, of not doing the diligence. Is there anything to add?
Experience. If you're choosing I would say it's impossible because I don't think anything is necessarily impossible here, but I would say it's very unlikely that somebody would come from a different industry entirely, maybe not even working in finance, and start a high-risk, financial institution or high-risk PSP. Good luck. They're not going to understand the nuances of the industry. You're going to want to work with providers that truly understand payments and financial institutions and banking as a whole before they choose to really go and dive down into the subset of supporting high-risk businesses. Because there's so much to consider beyond just the normal nuances of fundings and flow of funds. You've got to understand managing chargebacks. You've got to understand risk and underwriting. You've got to understand compliance. You've got to understand when and how and if to freeze accounts and hold funds. Reserves are a big thing. The match list is something to consider. All of those things are things that you're going to want to make sure that the you're choosing to get in business with understand. And so I think probably the big thing here is just choose your partners wisely. Do your due diligence to make sure that you're not just jumping with whoever's giving you the best rates because it'll cost in the long term, or who has the nicest pitch deck. It really is going to come down to experience when looking at this.
Yeah, usually I say that be cautious when something is too good to be true, because that it usually is, right? If it's too cheap, if it's too easy to onboard, even though I'm high risk, are you onboarding other high risk companies like me, like this too? If they just don't really dig deep in the documents, or maybe they don't pay attention to things, that's the red flag. Because if they are handling you and your money in this way, most probably they are doing the same for clients as well. And if that other client is doing anything, then it can really affect the payment providers as a whole. But it's very, very hard to filter out. Also, I usually say to the clients that read the reviews, and because unhappy customers like to talk about their bad experience. And if there is something going wrong, usually you see all of these different complaints on the Trustpilot and different kind of review websites, and that can show a lot of important information which might not be available in any other way. And if you can read between the lines, if they say that, oh, because whatever the technology is not that good, or they don't reply to your emails that quickly, but eventually the money is okay, then it's a whole different risk category than, guys, I'm texting you, where is my money? And then you see all of these reviews like that, then obviously that's a huge high risk. And surprise, some high risk companies are still desperate. And that just shows that how desperate you can be after multiple rejected applications or frozen account. And they still take the risk with that I personally wouldn't trust $2 on and still say that, yes, it's going to be fine. No, it's not going to be fine. If it is from the beginning, it's better not to touch it, because at the end of the day, you can lose so much more than just money. You can lose the reputation, the clients, even you can get a penalty on your own. So that could be a very dangerous game. Well,
and I think you mentioned earlier on this webinar that ecosystem thing. So you choose a provider that maybe they don't have the financials to withstand a few, deals gone south, if you will. It could impact you, right? It could impact your funding times. It could impact your through your platform, whatever it is. And you want to make sure that there's good financial backing. Again, back to that experience, that they've got some understanding of what to do, how much to hold in reserve to make sure that business operations are uninterrupted. Because it might not be anything that you're doing wrong, but because of the certain risk that the providers bring on is going to impact you. And there's really nothing you can do about that other than vetting anybody you're working with, or diversifying by having multiple providers, as we've been saying.
Get ready. Hope for the best, but prepare for the worst, right?
There you go.
So that's exactly. So how often should high-risk businesses really be reviewing their banking and payment strategies? Okay, if you're a hammer, everything looks like a nail. So I would say weekly, but of course it's not really logical. And what are the warning signs that they are walking into a financial disaster if they don't act fast? Maybe you can connect this to the data which can come from your system, because I think from our end I can talk sense, but your platform is the one who is really supporting that with data. So it would be interesting to see both points on that.
Yeah, I think this is one of those where, to the point about data, having some sort of key performance indicators or KPIs that are saying, like, this is happy state, this is kind of like DEFCON 2, this is like DEFCON 4, like where are we in terms of like how concerned we should be. This is the goal for the quarter. So I would say quarterly for your payment strategy. I think that you don't want to be redoing it too often. You want to let some kind of time go by so you can say, okay, what worked, what didn't work. Obviously, as you're a younger business, maybe weekly, but at least monthly is important. But as you kind of establish yourself, a quarterly cadence is probably best, so that you're not adjusting too much too quickly, that you're not able to see like what the impacts have on your business overall. But this is when you want to look at, maybe focusing on one or two things per quarter, and go from there. I know that we took an entire year. We were staffing our fat merchant. We said, we're going to focus on churn, and a subset of focusing on churn or retention, however you want to see it. A subset of that was not letting bad actors in, right? So then we, as the sales team and the operations team, were way more vigilant on, we're not going to let anybody through. We lowered some revenue expectations and numbers because we knew we were going to make that back on the other end of not having churn. So it all worked down the ecosystem, but it put the onus on the entire organization that, hey, this is not something that just impacts your risk team. It's something that impacts your entire organization. We all have to do our part. And so that was our annual strategy. But I think quarterly, we were able to get big updates on how things were going and where things were trending, ultimately to get to that kind of final goal. I think that's a really good way to kind of parse it out and work through it. So that way, at the end of the year, you're looking at a much more successful journey than if you were to do it too often monthly, or do it, just look at it annually.
Yes, and I agree with you. It really depends on the size of the company, the volume, and what are you looking at. Because if something comes out, like, for example, nowadays AI can revolutionize everything from Monday to Tuesday. You have to look at it, even if the time is not there yet. What can be done quicker, cheaper, easier, less risk, safer, into the whole payment processing. And if I need to adjust my marketing to support the payment, or the payment to support the marketing, I have to get involved and adjust either the payment strategy or the marketing strategy. And this could be very important, for example, when you're going abroad and then you target a new area, you need to find the relevant payment providers. And then they can really change their risk appetite, their technological level. They can have different kind of risks on you, and the user experience, of course. So payment strategy, I think, needs to be considered every time when the operation is doing something different than the usual. This could happen. And on the quarterly basis, just for external factors. or the bank, what we are using are still there? Are they still okay with our transactions? Or for example, change their risk appetite? Is there something better which came out? We are doing cards, but maybe tomorrow the big case for the new generation is different kind of wallet. Are we integrating them or not? So payment strategy has to be flexible enough to support every part of the operation, but on its own, it's also important to have regular review. And yeah, warning signs could be anything, because even though it doesn't affect the payment itself, it can originate, as you said, from sales. There is a sales hero who is starting to onboard all of those questionable new clients, which can affect everything. That's obviously needs to be addressed too. Or, for example, HR, the training, when people don't even understand the data security problems, that can also affect, payment processes. So there are multiple warning signs, and that's why you need either a platform or a very, experienced team, or better way, both, to highlight what could be those specific warning signs for your operation, for your activities, for your payment flows that you need to pay attention. And as you said, have a chief risk officer who is really doing nothing else but finding out what's the risk 8 hours a day, and highlight all of those weak areas when can go wrong. And absolutely priceless to have someone who's really understanding the whole operation from the risk perspective.
Right. So, entirely agree.
Yeah.
As far as warning signs go, I think, it's got to be chargebacks, and you've got to have some way to take a look at that in real time, if you need to. But I think that's going to be your early kind of warning sign that something's not going well. Something disastrous might be coming down. What's going on? Get out ahead of it. Because oftentimes the running, the client not even know. Right, they're the target of fraud. They're going through some sort of issues, and you getting out ahead of it can protect your business, can protect their business. And what you certainly don't want to do is get in the bad graces of anybody that's supporting your business, on the financial side. And so again, building trust, back to I think question number 4. Getting out in front of it, monitoring the chargebacks, giving a call to whoever, and making sure everybody's on the same page. That's all transparency. That's going to make sure that your business isn't interrupted.
I agree. And as we said, sometimes it's not even coming from payment, but it will affect payment. So bad quality, bad sales strategy, bad marketing, over-promising marketing will lead to more and more disputes. That it turns into chargeback, then it turns into penalties, lost merchant accounts, lost frozen accounts, and that can really affect you. So everything needs to be seen as a holistic approach, and that's one thing that I think we should really advocate more for, is that people really see not just the payment and banking as a finance function, but as a very vital process for the whole operation, which affects everything. Just as for example, now we are looking at a product as itself the leading management function, instead of having the waterfall method. And this is also part of that conversation, that marketing needs to know what HR is doing, and they need to know what finance is doing, and they need to know what payment is doing, and the whole ecosystem is working together as a team, and have an overall strategy for that. And if you're high risk, it's even more important for that. So yes, definitely. And I would like to ask the audience if we have any questions. I'm not quite sure if I can see these questions here. But if anyone has any questions or comments, then please reach out to us, because we love to talk about these kind of payment and banking complexities and issues. And this is how we find the solutions together for those problems together as a team. I can see that, in the private chat, you've got no questions. That means, Adam, that we were really clear on everything. It is great. And thank you so much again for just today. Describe a bit more where we can find you, how we can reach out to you, and what are the next steps?
Yeah, I mean, LinkedIn is a great place to go. Obviously, Victoria, thanks for putting my email up there. If anybody is considering multiple platforms, on any side of the fintech world that's really where our bread and butter lies. If you're a vertical SaaS company and you're thinking, I want to manage and hedge my risk here as I scale out my business, would love to talk to you about having multiple providers for anything in fintech. So that way your operations can kind of be more seamless, but everything can be very unified on the financial side through precision and the product that we've built.
Amazing. Well, thank you so much. And I would like to encourage everyone that please visit the soltessinstitute.com, click on the LinkedIn, write emails to us, reach out to us, because we love to talk about everything payment and banking. And thank you very much for the attention. The recorded version will be distributed all on the social media platforms. And thank you very much for everyone for the attention. Thank you, Adam.
Thank you, Victoria.